6 ETFs, a 10% blended yield, over $8,000 a month from a $1 million portfolio. That's not a hypothetical. That's the math using real monthly income ETFs you can buy today, managed by JP Morgan, Goldman Sachs, and NEOS. Billions of dollars behind every one of them. By the end of this video, you'll know exactly which 6 covered call ETFs make up this portfolio, what each one pays, and the real cost of that income, because there is one and most high-yield videos pretend it doesn't exist. Here's what caught my attention. One of the most popular ETFs on this list pays a 12% yield. Sounds incredible, right? But 95% of that payout is classified as return of capital. That's not necessarily bad news. In fact, for retirees, it might actually be an advantage. I'll show you why. Quick note, I'm not a financial advisor. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Let's build this thing. Every income portfolio needs a foundation you don't lose sleep over. That's JEPQ and JEPI, the twin pillars from JP Morgan. Start with JEPQ, the JP Morgan NASDAQ Equity Premium Income ETF. About $59 a share, roughly $40 billion in assets. The expense ratio is just 35 basis points. That's $3.50 a year on every $1,000 invested. The yield? Around 10.5%. It's paying about 64 cents per share every single month. And that monthly payout has been trending up. The July payment was actually the highest of the past 12 months. Here's why JEPQ earns the anchor spot. Over the last year, it delivered roughly 20% total return. That's your income plus your price appreciation combined. Now, that's a couple points behind the straight NASDAQ, but you're getting paid every single month while you hold it. For someone who needs cash flow, that trade-off makes sense. Now, JEPI, the S&P 500 version. About $57 a share, around $45 billion in assets. Same low expense ratio. The yield is about 8%, lower than JEPQ, but the holdings are more defensive, less tech, more stability. Here's the honest part. JEPI's 5-year annualized return is roughly 7%. The S&P 500 over the same period, about 13%. That's a real gap. You're giving up almost half the total return in exchange for that monthly check. Most people don't know that going in. Now you do. And that's exactly the kind of trade-off smart income investors make with their eyes open. In this portfolio, I'm putting 20% in JEPQ and 15% in JEPI. On a $1 million portfolio, that's $200,000 in JEPQ and $150,000 in JEPI. Annual income from just these two, roughly $33,000. That's about $2,750 a month. Solid start. But here's where tax strategy enters the picture. JEPQ and JEPI have a tax problem. Their income comes from equity-linked notes, and the IRS taxes that as ordinary income. If you're in the 24% bracket, a quarter of every payout goes straight to taxes. SPYI and QQQI, both from NEOS, solve this differently. They use index options on the S&P 500 and NASDAQ 100 that qualify for something called Section 1256 tax treatment. In plain English, 60% of the gains are taxed at long-term capital gains rates, 40% at short-term, even if you held the fund for a single day. That's a real structural advantage. SPYI yields about 12%. It crossed $10 billion in assets this year. It's paying roughly 51 cents per share every month. Very steady, very consistent. QQQI, the NASDAQ version, yields about 14%. It won Best New Active ETF at the 2025 ETF.com Awards. 1-year total return, about 27%. That's remarkable for a fund paying 14% income. Now, here's the part I teased in the intro. SPYI's 12% yield, roughly 95% of that is classified as return of capital. Sounds alarming, but think about it this way. Return of capital means the IRS doesn't tax that portion now. Instead, your cost basis goes down. You settle up later when you sell. Say you're in the 24% bracket and you receive $10,000 in distributions this year. If that's ordinary income like JEPI pays, you owe $2,400 right now. If it's return of capital, like SPYI, you owe 0 today. Your cost basis drops and the tax bill waits. For someone living off their portfolio in retirement, that's a meaningful cash flow difference. And here's the key. SPYI's share price isn't collapsing. It's up about 8% this year on a total return basis. The option premiums and portfolio growth are funding the distributions. It's not just handing you back your own money and shrinking.
Big difference, and most people lump all return of capital together without checking whether NAV is holding up. Don't make that mistake. I'm putting 20% in SPYI and 15% in QQQI. On $1 million, that's $350,000 total. Annual income from these two, roughly $39,000, about $32.50 a month. Quick question before we move on. If you're investing for income right now, are you putting your covered call ETFs in a tax-advantaged account or a taxable brokerage? Drop it in the comments. I read every single one, and I think the answers on this one are going to be all over the map. Here's where most income portfolio videos go wrong. They stack the highest yields, call it a day, and never mention what happens to the actual value of the portfolio over time. Smart income investors think differently. You need positions that protect your total return, not just your monthly check. GPIQ, Goldman Sachs NASDAQ 100 Premium Income ETF, about $58 a share, $5 billion in assets. Expense ratio 35 basis points. The yield is roughly 11%. But here's what sets GPIQ apart. Goldman's option strategy is less aggressive than most. They cap less upside, and the result speaks for itself. Over the past year, GPIQ delivered about 28% total return. That's the highest in the entire covered call ETF category. You're collecting 11% in income without giving up most of your growth. Think about that. Most covered call funds trail the S&P 500 by 5 or 6 percentage points a year. GPIQ barely trails it at all. Then there's DIVO, Amplify's Enhanced Dividend Income ETF. $46 a share, $7 billion in assets. The yield is lower, about 5%, but DIVO does something clever. Instead of writing covered calls across the entire portfolio all the time, they do it selectively, stock by stock, only when the premium is rich enough to justify capping the upside. The rest of the time, those stocks just grow. 5-year annualized return, about 11%. In a world where most covered call funds delivers 7 or 8, 11 is exceptional. Here's the thing. GPIQ and DIVO won't win any yield competition. But 5 years from now, when the ultra-high yield funds have eroded half their NAV, these two will still be standing. That's why they're in this portfolio. 15% in GPIQ, 15% in DIVO. On $1 million portfolio, $150,000 in each. Annual income from both, $24,000, roughly $2,000 a month. Let's put the whole picture together. 20% in JEPQ at 10.5%, 20% in SPYI at 12%, 15% in QQQI at 14%, 15% in GPIQ at 11%, 15% in JEPI at 8%, 15% in DIVO at 5%. Blended yield across the entire portfolio right around 10%. On $500,000, that's about $50,000 a year, $4,200 a month. On $1 million, about $100,000 a year, roughly $8,500 every month. Now let me think through the tax placement, because this is where the real money is made. Say you're 57, you've got $700,000 in your IRA and $300,000 in a brokerage account. JEPQ and JEPI go in the IRA. Their income is ordinary income. You want that sheltered from taxes as long as possible. SPYI and QQQI go in the brokerage. Their Section 1256 treatment and return of capital make them far more tax efficient in a taxable account. You'll pay less in taxes now and defer the rest. GPIQ and DIVO split between both, depending on your balances. That's not just an income portfolio, that's a tax-optimized income portfolio. And that one distinction, putting the right fund in the right account, could save you thousands a year in taxes. Most people never think about it. Now you have. Here's the myth. If a fund pays 40 or 50%, I can retire on a much smaller portfolio. Here's the truth. Those yields are shrinking fast. There's a category of ultra-high yield ETFs out there right now. Funds paying 30, 40, even 50% on paper. YMAX, QDTE, FEPI, some of the single stock yield max products. The numbers look incredible on a screen. But look at what's actually happening. YMAX, which holds about 31 YieldMax ETFs stacked together, has seen its weekly distribution drop over 30% in the past year. The share price has fallen right alongside it. FEPI, a fund holding mega-cap tech stocks with a heavy options overlay, currently reports 100% of its distributions as return of capital. Its 30-day SEC yield is near zero. That means the fund isn't earning the income it's paying out. It's handing you back your own principal and calling it a dividend. Can you use these? Maybe. 5 to 10% of a portfolio, a small, clearly labeled satellite position, but build your retirement income plan around a 40% yield? That's not a strategy. That's a countdown. Here's the line I want you to remember from this video. A yield you can keep beats a yield you can't trust. Write that down. Say it out loud. It will save you more money than any single ETF pick ever will. If someone you know is chasing yield right now without seeing the full picture, the return of capital, the NAV erosion, the tax placement, share this video with them. It could save them from a very expensive lesson.